Hello, everyone, and welcome to the November 2024 Market and Election Update. Today, I'm going to be your presenter, Daniel Krug. I'm the CEO and Senior Wealth Manager for Daniel Krug and Associates. Today, we're going to be talking about the economy and the election results and the updates thereof. We want to thank City National Rockdale and Clark Capital Group really for all the research that they do for us to help us with putting this presentation together for you. Now, awesome day today, awesome week. It's been a great run up in the market, which is really nice to see. We've had a phenomenal year from a return standpoint. And now let's talk about where are we going to be for the end of this year and probably more importantly, towards the end of 2025. So let's go ahead and get started. First thing I want to talk about is the economic speedometers. And again, these are brought to you by City National Rockdale. They put these speedometers out on a monthly basis, and it allows us to really see what is going on in our economy and the financial markets, and it allows us to gauge from month to month to see which direction we're going. So let's look at November. And again, if you look at them, the way you're going to read them are you've got green dials, yellow dials, and red dials. Green is good, yellow is neutral, and red is negative. And as you can see, we've also got these green boxes around specific indicators, and they are letting us know that the indicator is actually going in a positive direction. In other words, if you looked at October and you looked at November, you'd see that the dials on these speedometers have moved in the proper direction. Let's start with the monetary policy. Again, that has been improving over the last year, and it's continuing to do so. You know, it's going to be interesting with the election and Donald Trump coming into play here, how that is going to change. But, you know, I'm kind of hopeful because if you think back to the 2016 election, the monetary policy stayed pretty positive throughout his whole term. The other is the consumer sentiment. You know, on a monthly basis, they look at the consumer sentiment and they want to know what the consumer is thinking. Are they pessimistic or are they optimistic? Because if you think about it, the consumer drives about 70% of the nation's GDP. And in this case, the consumer sentiment is actually rising. Matter of fact, there was actually a poll done after the election, and it is moving even further in a positive direction because people feel like the economy is going to really kind of kick in for them individually. The next one is interest rates, and as you could tell, and you've probably heard, the Fed has cut rates another quarter point, and that bodes well for lowering interest rates on mortgages, car notes, things like that. And then you look at fiscal policy, which fiscal policy is getting much better as well. I'm going to go over to the business outlook because if you think about it from the market, the business outlook and the earnings in businesses and the potential to grow is really what is going to drive the stock markets. And as you can see, it's etched up a bit too into the positive territory. In other words, businesses are looking forward in the market and in their specific industry and thinking, listen, I've got room to grow here. And that again bodes very well for potentials for the market. And then lastly, you've got energy cost. Energy cost has improved a little bit, so there is a green box around there, but it is still running neutral. What the optimists are looking at is with the Trump administration coming in, that energy costs are again going to go back down, and that bodes well for businesses and your individual households. So that's looking really good. So let's move on. Trump won. What does that mean for the markets? Well, if you recall over the last few months, and you've probably seen it in other places, where the chart for the stock market, regardless of whether there was a Republican or a Democrat in office, continually moves up. Now, what determines whether it goes down? Generally, that's a recession. And you can see on this chart, you've got the blue line, which is the earnings per share, the EPS, which again is looking very positive right now. And then you've got the correlating red line, which is the S&P 500. And you can see over time, it just makes this nice ski slope up. And we're anticipating that moving forward in 2025. So going back to the market returns after the election, and this is a real positive statistic that I'm going to be showing you here, because a lot of people are like, well, you know what? If the Democrats get in, the economy is going to be bad, the market's going to go down, and others are saying if the Republicans get in, the market's going to be bad, it's going to go down. Well, that's really not how it works out there. The market really doesn't care whether it's Republican or Democrat. They care whether the environment is going to allow them to grow. So when you look at this chart on the right-hand side, or excuse me, your left-hand side, you'll see the average, median, higher, and count. Now, what do those mean? The average is really the average rate of return. The median is the median rate of return. Higher means how many terms, election terms, did the market actually go positive? And then the count is looking at the last 10 elections. And then if you look at the top line, you've got next month after the election, 3 months after, 6 months after, and then the following year. And when you look at these numbers, just from an average standpoint, you can see a pretty positive picture that's being painted for getting through the end of this year and then also projected out to 2025. Historically, over the last 10 elections, the average rate of return in the following election year is actually over 15%. And if you look at the median, it's even higher. And again, going out 1 year, 9 times out of the 10 election periods, it was positive. So we're looking at this and saying, well, that's a very positive sign to be in the stock market. Now let's go on. Okay, let's talk about the S&P 500 and earnings, because again, earnings is what's going to drive the market. And as you can see on this chart, it goes back to 2019 all the way up to the estimates in 2025. And the way you want to read this thing is really the blue are years that are already in the records. And you can see even from 2019 through 2023, with possibly the exception of 2020, which again, everybody knows we shut down the country at that point. We would have expected the earnings to be low at that stage, but they bounced right back in 2021. 2022 was good. 2023 was even better. And they're forecasting for 2024 to be even better. And to put the icing on the cake, the forecast for 2025 is even better than 2024. So the earnings are definitely going in the right directions. And again, like the statistics that you saw relative to the year following the presidential election, you're seeing that earnings are also showing that same sign of increase. And like I said, earnings is what drives the market. When a company is very, very productive and they end up with good earnings, with sales, it drives the stock market forward in a specific company. So this again is a very positive sign. As you can see, with the new administration, the regulatory environment will likely ease, particularly with regards to energy, financials, and labor policies. Again, bodes well for the stock market. And when you think about the tariffs, Trump is going to put more tariffs in place, but you really have to look back in history. He didn't do it in such a way that created A, inflation, and B, ruin the economy. In fact, it actually did the opposite. And, things got better under the tariffs that were put into place. So you can expect them to be putting a measured response relative to tariffs. And then, again, when you're looking at the words were said during the campaign, they were looking at more like 10 to 20% across the board. I just don't think it's going to be that heavy, even with, a Republican House and a Republican Senate. And then lastly, now that the election is behind us, we believe the markets will return to focusing on fundamentals such as corporate earnings, interest rates, and the economy. And again, that's what we should be focusing on, because it's the numbers, it's the stats that we get that literally are going to decide whether we're going to propel forward or fall back. And right now, the signs are really looking positive for us. Here's where we are year to date based on these three different index performances. And you've heard us talk about the S&P 500 capital weighted and equal weighted. The capital weighted, again, is pushing forward year to date, 26+%. And since the election, it's up 4.8. You look at the equal weighted, not up as much. Why? Because again, it's driven by the broader market, not a handful of tech stocks, which is actually still pushing the S&P 500 capital weight way ahead of the broader market. But even looking at this year to date, we're at 4.4% on the equal weighted. Now, where are we having problems right now? Well, it's the bond funds. The U.S. Aggregate Bond Fund, AGG, is effectively year to date down almost 1%. And since the election, down about 0.3. So we've said this before, we are in a secular bear market for bonds. At the beginning of the year, we were down. Halfway through the year, we were up about 4%. Now we're down again. And it's just going to be that sideways market for bonds moving forward, until something major changes. And we're not really looking at that happening for another 5 years or so. So it is important to understand how bonds are going to affect the overall portfolios when you're looking at more conservative investors. One of the reasons we've been using the money market accounts, because at least there, we're going to get between 4 and 5% within that account for those clients. That's not a bad rate of return when you think about the alternative with bonds, which just are not performing. So lastly, I want to look at the Feds, because this is another one that's really going to indicate what is the market going to be looking for and where is it going to go in the future here. And that I've already said the Feds have cut rates by a quarter point already in the last month, and they're expecting to cut again in December. Not only that, in 2025, they are expecting to cut another 50 basis points. So what does that do for the economy? What does that do for the stock market? It's a very positive thing. And think about it this way. Small companies, mid-cap companies are more interest rate sensitive than large cap companies are. So as these interest rates go down, you see the broader market moving forward. And you can see here, when the Fed really goes to cut rates, there's kind of a tale of two cities here. One is if the Fed cuts, what happens during a recession? And the other is the Fed cuts and there's no specific landing, which is where we are today. And you can see on the column on the right, where the Fed cut, no landing comes into play, you can see the percentage return on average 3, 6, 9, and 12 months later. Again, it's kind of mimicking what it looks like when you have the election. So goodness gracious, all signs are showing a positive rate of return. Now, some of you might say, well, what about that dip that we were supposed to get? Well, at the end of the day, the dip We don't think it's coming now. And there's multiple reasons for that. And it really comes down to data. You know, you go back 3 months, 6 months ago, the data was all pointing towards a dip. You accelerate to today, the new data coming in is all targeting a higher rate of return. That's what it's pointing towards. So that's exactly what we're looking at right now. So if we've got clients that are in money market accounts and that money was designated to go back into the market, we're putting those funds back into play at this point. In addition to that, if there are Roth conversions that need to be done, we're also initiating the Roth conversions at this stage. So you can expect that if you have money in a money market that's not sitting there to be a bond alternative, and we have it designated to go into equities, you'll be seeing that money move into those equities over the next week or so. So if you go to our website, you can get all sorts of information there. We've got plenty of videos. Just click on Watch Us, then DK&A YouTube. It'll take you directly to our YouTube site where you can see snackables, which are short videos, 3 to 5 minutes, or you can get right into the nitty-gritty like a full version we have today. And it'll just, again, give you a lot of information about the markets. It'll give you information on advanced planning strategies that we do and help keep you educated. That's all for today. And there is no need to worry. We are ready for 2024 and beyond. Matter of fact, we're about to jump into 2025. So you take care of your family and we'll take care of you.